Investing in the stock market offers opportunities for financial growth, but it also comes with risks. Markets can be volatile, and even the most promising stocks can experience sharp declines. This is why experienced traders and investors use stop-loss orders to minimize potential losses and protect their portfolios from severe downturns. A stop-loss order is a risk management tool that automatically sells a stock when its price drops to a predetermined level. It helps investors avoid emotional decision-making and ensures they exit a trade before losses become overwhelming. Whether you're a short-term trader or a long-term investor, understanding how to set stop-loss orders effectively can help safeguard your investments. How stop-loss orders work. A stop-loss order acts as a trigger. When the stock price hits a specified threshold, the order converts into a market order and executes the sale at the next available price. For example, if you buy a stock at $100 per share and set a stop loss at $90, your shares will automatically sell if the price falls to $90, limiting your loss to 10%. Stop-loss orders are particularly useful during market downturns, earnings volatility, and unexpected negative news. They allow investors to preserve capital and reinvest in better opportunities rather than holding on to a losing position. Types of stop-loss orders. 1. Fixed stop-loss orders. A traditional stop-loss order where you set a fixed price level at which the stock is sold. It's simple and effective for short-term trades or when you want to establish a clear exit strategy. 2. Trailing stop-loss orders. This type of order follows the stock price as it moves up. If a stock rises, the stop-loss level automatically adjusts by a set percentage or dollar amount. However, if the stock falls, the stop remains fixed and will trigger at the new level. This helps lock in profits while still protecting against downside risk. 3. Percentage-based stop-loss orders. Investors often use percentage-based stop-losses, such as 5, 10%, or 15% below the purchase price to manage risk based on their individual tolerance levels. 4. Volatility-based stop-loss orders. Some investors set stop-loss levels based on the stock's historical volatility. Highly volatile stocks require a wider stop-loss range to avoid being triggered by normal price fluctuations. How to set an effective stop-loss order. 1. Consider your risk tolerance. If you're a conservative investor, a tight stop-loss, 5 to 10%, might be ideal. If you're willing to take more risk, a wider stop-loss, 15 to 20%, may prevent premature exits. 2. Analyze market conditions. During bull markets, stocks tend to trend upward, so a looser stop-loss allows for normal price fluctuations. In bear markets, a tighter stop-loss can prevent bigger losses. Use support and resistance levels. Identifying key support levels where a stock tends to stop falling and setting stop-loss orders just below them can be effective. If a stock breaks below support, it often continues downward. 4. Avoid setting stops too tight. If a stop-loss is set too close to the stock's current price, normal fluctuations may trigger an unnecessary sell-off. Number 5. Review and adjust your stops regularly. The market changes, and so should your stop-loss strategy. Reviewing your stop-loss levels periodically ensures they align with your investment goals. Pros and cons of using stop-loss orders. Pros: limits downside risk, prevents catastrophic losses by exiting positions automatically, eliminates emotional decision-making, helps investors stick to a disciplined trading plan, allows traders to manage multiple positions. Investors don't need to monitor every stock constantly. Cons: gaps in price movement. If a stock drops sharply overnight, the stop-loss may execute at a lower price than expected. Short-term market fluctuations. A stock might briefly drop below your stop-loss and then rebound. Execution during high volatility. During rapid price swings, orders may not be filled at the exact stop-loss price. When to use stop-loss orders for short-term trades. Traders use stop-loss orders to lock in gains and prevent large losses. During earnings reports, stocks can swing dramatically based on earnings, so stop-loss orders can reduce exposure to bad surprises. To protect gains in a rally, a trailing stop-loss can help investors hold on to winning stocks while protecting profits. In uncertain market conditions, stop-losses provide security during economic downturns, political instability, or unpredictable events. Final thoughts. Stop loss orders are an essential tool for investors looking to manage risk and protect capital. While they aren't perfect and require strategic placement, they help ensure that small losses don't turn into devastating ones. Whether you're day trading, swing trading, or investing for the long term, mastering the art of setting stop losses can make a significant difference in your overall success and financial security.